If you have any exposure to commodities, particularly precious metals, a critical signal has just appeared. This isn't about the daily price swings. This is about the structural integrity of the market itself. What I'm about to lay out is why the contract you believe you own might no longer be honored. So let's start with this number, 82 million ounces. This represents the entire registered silver inventory that is supposedly available for physical delivery on the COMEX, the Western world's main exchange. Think of it as the baseline, the final buffer.
And to be perfectly clear, this inventory is supposed to be the ultimate backstop for the global physical market. It's the final reserve for every corporation, every industrial user, and every investor who wants to take delivery of actual metal, not just a paper promise.
Now look at this number, 85 million ounces. This is the amount of physical silver that a single corporation, Tesla, secured in a private deal on January 13, 2026. Let that sink in. One company just contracted for more silver than the entire exchange claimed to have available for everyone. This is where the system breaks down.
This is not a rhetorical question. It points to a mathematical impossibility, and it exposes a profound counterparty risk that's been hiding in plain sight in our financial markets. Understanding how this happened is absolutely essential for capital preservation right now.
You see, an event like this was not an anomaly. It was actually the logical conclusion of a structural trend that's been building for years. A trend that's been systematically ignored by most. This isn't the start of the problem, it's the breaking point.
For years now, there's been a persistent and growing gap between how much silver is mined and how much is consumed. Just in 2024, the world used 270 million more ounces of silver than it produced. And that deficit has to be filled from somewhere. It's been eroding the world's above-ground stockpiles at an accelerating pace.
And you can see the result right here. That persistent deficit has drained the physical buffer. The inventories in Western vaults, the system's shock absorber, have collapsed by over 70% since 2020. This left the market incredibly fragile, structurally vulnerable to any large-scale demand shock. Tesla was simply that shock.
So, this brings us to the first strategic pillar you need to understand. To protect your capital, you must grasp the failure of the paper market. It is simply no longer a reliable pricing mechanism for the real physical asset.
Just look at the scale of this disconnect. For the upcoming March delivery month, there are contracts out there demanding 225 million ounces of silver. But after the Tesla purchase, the physical inventory available to meet those demands is effectively negative. The system is quite literally mathematically broken. So how does the system resolve this impossibility? Well, the answer lies in a legal clause called force majeure. This is the mechanism that allows an exchange to legally default on its physical delivery promise and just settle contracts in cash. For anyone holding paper instruments, like futures or ETFs, this means your claim on physical metal can be legally erased and replaced with depreciating currency.
The primary risk in this asset class has now fundamentally shifted. It's no longer about price volatility, it is about counterparty failure and the integrity of the contract you hold. The question isn't what's the price anymore, it's can my contract actually be honored for the underlying asset?
Now, if this all sounds unprecedented, it's not. This leads to our second strategic pillar. There's a clear historical precedent for this. The blueprint for what happens next was already written by the palladium market.
Between 2017 and 2021, palladium repriced by over 400%. It started with a quiet structural deficit, which was dismissed as just a temporary shortage. It ended with full-blown industrial panic as car companies scrambled to get physical supply at any price, just to keep their assembly lines running. The narrative followed the price, it didn't lead it. But here's the critical difference. The palladium squeeze was driven purely by industrial need. Silver has that exact same driver, but it also has a powerful monetary accelerant.
As a historic store of value, silver attracts safe haven investment during times of financial stress. This means you're going to see industrial panic competing directly with investment panic for a dwindling supply. The silver scenario has a demand multiplier that was completely absent in the palladium precedent, and that increases the potential velocity of the whole repricing event. The mistake most investors are making is looking at this through a purely industrial lens, totally failing to account for that monetary accelerator.
This brings us to the most critical insight for navigating what's happening. The biggest mistake most market participants are making right now is that they're focused on completely the wrong signal. Right now, the mainstream narrative, looking at a spot price of $92, is debating whether silver is in some kind of speculative bubble. This is a total distraction. The true signal isn't the price of a paper derivative. It's the terminal decline of physical metal available for delivery.
And we have a perfect case study. Tesla was willing to pay premiums of $50 to $70 an ounce over the spot price. They weren't buying a paper contract at $92. They were securing physical delivery for something closer to $150. That massive divergence between the paper price and the physical price, that is the most important signal in the market today. It tells you what it actually costs to get the real asset, not just the claim.
So let's synthesize all of this into a single strategic takeaway. This isn't about predicting a price target. It's about understanding a fundamental shift in market structure and having the right mental model to navigate it.
This is the core strategic lesson from this event. The bedrock assumption that a paper derivative is a perfect proxy for a physical commodity, well, that assumption is no longer valid once inventories are gone. So this gives us an actionable framework you can apply to any market. First, identify assets that have these persistent long-term supply deficits. Second, monitor the physical inventories and the premiums. Those are the true indicators of scarcity. And finally, and this is the most important part, understand the difference in your own portfolio between a financial claim and ownership of the physical asset itself.
This analysis isn't speculative forecasting. It's a framework for positioning capital defensively in an environment where counterparty risk and the integrity of contracts have suddenly become paramount.
Before we depart, remember, the financial landscape is constantly shifting. The insights shared here are for educational purposes only. They do not constitute financial, investment, or legal advice. Every investor's situation is unique, and you should always consult a certified professional before making major decisions. Our goal is to help you identify the signal, but the final move is always yours. Stay sovereign, stay informed.